When I look, Aaron, at the February reset of the economy, the reset, as you correctly say in your research note, is for a slower economy. How slow is slow? I get Italy in recession, Euro 1%. When you bring that over to the U.S., what do you see for U.S. economic growth?
Yeah, so we've penciled in about 1.8, Tom, for the first quarter. But then by the second quarter, we're already re-accelerating probably to a pace a little in excess of 2% as the trade uncertainty starts to fade.
David Riley, help us with your February reset. How do you change asset allocation at Bluebay?
Well, I think on the back of the reset by the Fed, it opens a window of opportunity to add some risk in emerging markets, and we've taken the opportunity in some of our strategies to add to some of our emerging market exposure, particularly in emerging market local currency debt.
How much of that is based on the pause that you may or may not expect from the Fed this year?
Well, a big portion is based on that. I think there's a couple of things going on. Firstly, that the deceleration that we've seen in global growth has actually more recently been led more by developed markets than emerging markets, and we already had a lot of, if you like, weak growth priced into emerging market assets. You then put on top of that one of the big sort of headwinds for emerging market assets last year was the tightening in dollar liquidity. The Fed is most certainly on pause. It sounded like they'd almost come to an end, in fact, at their last press conference in terms of the hiking cycle. Dollar's kind of drifting, and we do think that we're likely to get some kind of truce in the US and China. So when you put together relatively attractive valuations on emerging market assets,
yes,
I think a more positive growth outlook for EM, relatively speaking, compared to expectations, and a Fed on pause is a good opportunity for investors to go into EM.
Yeah. Arend, let me bring you back in, because when you've compared in your research developed markets versus emerging markets, I believe you came to the conclusion that external factors mattered more for developed markets. So you look at that side of the coin, but then you look at the jobs data that we got on Friday. When you balance those two out, are we going to see a Fed on pause, but that starts hiking again in the second half of the year?
Right. So the strange thing is that when you look at the whole world, those external factors matter to all countries except the U.S. So in the U.S.,
right,
you don't see that external weakness. And so they've been a little bit the odd man out. So I think you need to look at the U.S. separately. And in the U.S., what you have is a bit of a disconnect between the labor market, which looks very strong, and everything else, which looks quite weak. So housing is weak, residential investment is contracting, investment has slowed down. And so it's a little bit unclear what to make of that. Even in the employment data, there are some puzzling things. So the household survey, which no one sort of really pays attention to because it's quite volatile, showed a contraction in employment on Friday, whereas the payrolls were going up. So I think it's a bit of a mixed picture. I think overall, U.S. is hanging in there, whereas everything else is sort of slowing around it.
Right, and that means, therefore, that we're going to see what in terms of the dollar for 2019?
Yeah, so what's happened is two things simultaneously. So one is, obviously, we've priced out the Fed hikes, and so that's been a big move in yields. At the same time, we've had a big loss of global growth momentum. If you think about euro-dollar, those have happened simultaneously. So the European economy is slow to a halt, basically, at the same time as we've priced out these Fed hikes. And so euro-dollar has sort of done nothing. It's basically sort of moved sideways. Now what's going to happen is everything's going to go into reverse. So I think we're probably going to price back some Fed hike again, so we have one penciled in for September. But we're also going to get that re-acceleration in growth in Europe, I think, by the middle of the year. And so net-net, what it gives us is a slow grind higher in euro-dollar. I
got to go sophisticated here. David Riley, December down, January up. What do you see for February? And could you say there's a Powell put involved where up is guaranteed?
Oh, I don't think anything's guaranteed. I wish it was otherwise the case. But I think you're right, Tom, that, you know, as you've alluded to, we had basically a panicky sell-off in December. Markets overshot. We've taken much of that back, if not all, in equity markets, although interestingly not in rates, and only sort of two-thirds of it back in terms of credit, particularly within Europe. So I think that sets us up if we do get a truce in the trade conflict between the US and China, for basically markets to kind of climb a wall of worry and to grind higher. But we've clearly had a very strong January. I don't expect that to be repeated in February. And just one thing I would also say is that I do think that investors right now that I've been speaking to and asset allocators haven't actually committed huge amounts to this rally, because they do remember, of course, that last year, at the beginning of the year, we had a very strong January and February. People got very aggressively sort of long risk, very consensual positioning, and then it was pretty painful thereafter. And I think that a number of investors haven't been as quick to commit capital to this rally, which gives me, I think, some comfort that we can kind of grind on a little bit further, even after what's been a very strong January.